What is up? Steve here. I hope you are doing well. We have some scary information. We're going to review it today, where mortgage demand falls to the lowest level in 22 years. That means before the Great Recession around the year 2000. So let's jump into this article here. It goes on to say, total mortgage application volumes fell 6.5% last week compared with the previous week, according to Mortgage Bankers Association. Demand hits the lowest level in 22 years. The average contract interest rate for a 30-year fixed mortgage with conforming loan balances $647,000 or less increased to 5.4% from 5.33%. There was a little bit of a period of time where it dipped down. Now it's jumping back up. So before we proceed further in this article, let's talk some quick math. If you bought a house at $400,000 and you got in at 2.75%, you're looking at a payment of $1,375. Now, if you got in at 3.5%, which is still a hell of a rate, your payment was $1,550. Now, current day, we're about 5.5%. That same house is going to cost you $2,063, which is about $650 more per month compared to the guy that got in at 2.75. And let's say rates go up to 6.5%. I think that we're going to see 6.5%, 7% maybe toward the end of the year, if not Q1 of 2023. That's just my personal opinion with the rate hikes that the Fed's going to do. If you're at 6.5%, you're looking at a payment of $2,342 per month. As you can see, the same house that the guy paid 2.75% in interest, you're talking almost $1,000 spread in terms of where this guy and this guy are at. Now, let's say that this guy can only afford $1,375. That means at the current rate at 5.5%, the purchasing power of this person is $240,000. With points rising, points are basically the amount that it's going to cost you up front to get these mortgages as well, because in the mortgage market right now, they're looking at every borrower as basically a more risky borrower, so they're charging more up front. And they're rising to 0.6 from 0.51, including the origination fees for loans with a 20% down payment. If you have less than 20% down, you could be looking at even a higher amount of points charged up front. Refinance demand, which is the most sensitive to weekly rates move, fell another 6% for the week and was 75% lower than the same week a year ago. The vast majority of mortgage holders now have rates considerably lower than the current one, and even those who would like to pull cash out of their homes are choosing second mortgages rather than refinancing their first liens. Now, I think it's important that we discuss real quick that if anybody is refinancing out of a lower rate right now and they're going into a higher rate, that means that they're probably in some sort of trouble. So pass this video along to them, because it's important that they really keep those mortgages, or maybe even decide to sell their property if they are in some sort of financial trouble. Other people right now are taking on home equity loans, HELOC loans, and unfortunately, some of those people are utilizing those loans not just to fix their properties up, but some people are buying liabilities like boats and cars and so forth, and then other people are just taking money out to have money on the sidelines to pay bills because of the cost of everything going up with inflation. Applications for a mortgage to purchase a home fell 7% for the week and were 20% lower than the same week ago. And I do want everybody to keep in mind too, with the mortgage demand lowering, there's a big wave of new construction properties coming to market. Right now, it's estimated there's about 1.6 million homes under construction. And I've done other videos about people walking away from their new construction properties because they were unable to lock in at lower rates, say 3.5%. Now their rates at 5.5%. It's a big difference in your mortgage in terms of the interest that you're paying on the loan. So we have 1.6 million new construction properties coming to market, and I anticipate that's only going to basically trickle into the market, flood the market a bit. It's going to cause prices to go down. The purchase market has suffered from persistently low housing inventory and the jump in mortgage rates over the last 2 months. Now, we're hearing a lot of government entities talking about how we can create affordable housing. And unfortunately, you know, the government and the Fed were part of the problem, and now they're trying to come in and fix the problem. And unfortunately, they just need to step out of it. So when they came in and they dropped basically the Fed rate to 0, that brought the cost of borrowing down to basically, you know, people are getting 30-year fixed rates at like 2.5%. So the cost of money to buy a property was a no-brainer. That's why a lot of people flooded into the market. And then, you know, they bought up all the homes that were available. So you have simple supply and demand. And now with interest rates rising, we're going to definitely see a big shift in our housing market. Time will tell what will happen, but I anticipate we're going to see rates increase even higher with the Fed increasing rates. They're talking about 50 basis points literally every meeting until the end of the year. And I think that they're going to keep raising it until really real estate stands at a standstill. And we're seeing it right now with mortgage demand at its lowest point right now in 22 years for demand. It is amazing, and there's going to be some turmoil in the markets. So I recommend, if you guys have a house with a low interest rate, keep that property. If you can rent it out, if you run into financial problems, if you can rent it out and you can make money on that property in terms of renting it, hang on to that property, because that'll be a great asset for you and your family in the future. Other people, if you're just in a bad financial situation, maybe right now might be the time to list your property for sale. And if you are a buyer, you know, my opinion on if you're a buyer right now is, you know, I go back and I said this in a couple other videos, I would rather pay a really high interest rate on a property that I bought right, where I bought the property cheap. So I would pay a 20% interest rate on a property that I bought very, very cheap, because there's options to sell the property, flip it, and there's also opportunity for in the future when rates come down, because eventually they will, if it reaches a really high rate, that I can go ahead and refinance that property. But buying high with a high interest rate is just, it's not in my DNA. And anyway, that's me. That's my personal information, and based on my experience as a real estate broker here in Southwest Florida. And I just want everybody to make logical decisions, whether you're buying or selling real estate. And let me know your thoughts below on the market. And if you got value out of this, I appreciate you sharing it with anybody that you know that can benefit from it. Thanks a lot for being here.